You have 15 minutes to read the question. Ignore value-added taxation in all amounts unless specified differently. Handbag Ltd is an entity specializing in the manufacturing and sale of luxury leather handbags. Due to a steady decline in sales as a result of the strain on global economic markets, Handbag Ltd decided to diversify its operations by investing in a few different entities. All entities in the group has a 31 December 2018 year end. Investment in Briefcase Ltd. Handbag Ltd purchased 60% of the shares of Briefcase Ltd for 20 million on 1 March 2018. The 20 million cost of the 60% investment in Briefcase Ltd is made up as follows: 17.5 million cash payable on 1 March 2018, which includes 500,000 costs associated with the business combination, 2 million cash payable on 28 February 2019. Immediately you need to identify, we need to calculate a present value. Then 1 million cash payable on 28 February 2019 should Briefcase Ltd reach the promised level of production by that date. The fair value of this payment correctly determined was 800,000 on 1 March 2018 and 850,000 on 31 December 2018. Experts deem to be highly unlikely that the desired level of production will be reached by 28 February 2019. Now, why did they provide us with this? First, we need to identify that Briefcase Ltd will be a subsidiary and we will have to apply our principles of IFRS 10 and IFRS 3. Now, when we look at the principles of IFRS 3, remember, this will be our parent will have to pay consideration based at fair value to the previous shareholders of the subsidiary, and all identifiable assets and liabilities should be included in the group at fair value at acquisition date. Now, we are able to identify that our acquisition date is 1 March 2018, and we need to calculate the consideration paid by Handbag Ltd for the 60% shares in Briefcase. Then what you need to be able to identify from the last bullet point is that this is a contingent consideration. Then they indicate to us the following extracts from the Statement of Comprehensive Income are available for the year end 31 December 2018. Now they provide us with the sales, cost of sales, other income of Handbag Ltd as well as Briefcase, income tax, profit after tax. At 1 January 2018, the equity as recognized by Briefcase Ltd consisted of the following: share capital 100,000 shares, value 10 million. Retained earnings 20 million. Important to identify, guys, that this is on 1 January 2018. Our at acquisition date provided to us is 1 March 2018. Therefore, they provide us with share capital retained earnings on 1 January. Included in the net asset value on date of acquisition were also the following items: land with a fair value at acquisition date of 12 million and an original cost of 5 million. We need to identify fair value adjustment or revaluation surplus, and this is land, therefore tax based on CGT rate, that we need to include in our at acquisition section on our analysis of owner's equity. Why? When you look at our principle, remember, all identifiable assets and liabilities should be included at fair value into our group. On the acquisition date, Handbag Ltd became aware of a pending court case against Briefcase Ltd. This court case was initiated by angered former employees who were unhappy about being retrenched. The legal advisors of Briefcase Ltd deemed that a present obligation exists but did not view the outflow of future economic benefits to be probable. Now, this is our principles in terms of IAS 37. Therefore, we need to identify in the separate records of Briefcase. They did not recognize a liability. But in the group records, in terms of IFRS 3, remember we need to include our identifiable assets and liabilities. Therefore, we need to recognize a contingent liability in our group. The legal advisors also estimate the fair value to be 5 million. Briefcase did not recognize any amount in its separate financial statements. Any amounts payable in terms of the court case will be tax deductible. The initial accounting was considered to be final in terms of not provisional as at 1 March 2018. During the period 1 March 2018 to 31 December 2018, the group financial reporting date, the following occurred. Briefcase Ltd paid a monthly management fee to Handbag of 50,000. We need to identify that this is an intra-group transaction and we need to eliminate the transaction in our group. Important, guys, Briefcase, our subsidiary, paid this to Handbag. The monthly sales and cost of sales of Briefcase Ltd increased by 10% from 1 July 2018. Other expenses, except for the management fee and other income, were incurred evenly on a monthly basis throughout the 2018 reporting period. Now, we need to identify the indicator as Briefcase. Monthly sales and cost of sales increased by 10% from 1 July. Then our other expenses, except for the monthly management fee at the top, occurred evenly. Briefcase Ltd declared and paid a dividend of 7 Rand per share on 1 October 2018. Briefcase Ltd sold the land to independent third parties for 14 million in December 2018. Therefore, we need to identify in our group, we will have to reverse our fair value adjustment that we have identified at the top. Guys, remember, we have identified at acquisition date that there will be an adjustment of 7 million on our land. This is the difference between the 12 million and the 5 million. This is 7 million. And now, due to the fact that they've sold the land, we will have to identify that we need to reverse the transaction. The legal advisors of Briefcase Ltd deemed the outflow of future economic benefits due to the court case between Briefcase and the former employees to be highly probable. IAS 37. Therefore, you need to now identify if this is highly probable, guys, in the separate records of Briefcase. Briefcase will now have to recognize the provision. Therefore, in our group, we will have to now reverse the transaction. Okay, guys, don't get confused between our separate records and our group records. Consequently, Briefcase Ltd recognized a provision of 8 million in its separate financial statements in relation to the court case. You must assume that the provision has been dealt with correctly in the separate financial statements. Investment 2, Investment in Wallet Limited. You will identify, I prefer to make use of different colors: Handbag, yellow; Briefcase, light orange; and Wallet will be green. On 1 January 2017, Handbag Limited acquired 25% of the issued ordinary share capital of Wallet Limited at a cash consideration of 720,000, and since this date exercises significant influence over the financial and operating policy decisions of Wallet. Immediately, this is an associate and we need to apply IAS 28, equity method accounting. Now guys, Handbag, yellow, Wallet, green. The following analysis of the at-acquisition equity of Wallet Limited, which you must assume is correct, is available. On 1 January 2017, the equity as recognized by Wallet Limited consisted of the following: share capital of 2.5 million, retained earnings of 700,000. All the assets and liabilities of Wallet Limited were considered to be fairly valued on acquisition date. The retained earnings accumulated losses amounted to the following: 31 December 2017, a loss of 500,000, and in 2018, a profit of 200,000. Now, important to read, guys, this is the retained earnings account. Since 1 January 2017, Wallet Limited purchases all of its inventories from Briefcase Limited at a cost plus 20%. Therefore, you can assume that your cost will represent 100%, your profit portion will represent 20%, and your selling price will represent 120%. Now, important to read, since 1 January 2017, Wallet Limited purchases all of its inventories from Briefcase Limited at a cost plus 20%. Therefore, when you think about your structure, we have Handbag, and Handbag owns Briefcase. This is a subsidiary. And Handbag has shares in Wallet, and this is an associate. Now they indicate to us, Wallet purchases all of the inventories from Briefcase. Therefore, Briefcase is our seller and Wallet is the buyer. And this is from 1 January 2017. However, Handbag only acquired Briefcase as a subsidiary when 1 March 20.18. Okay, guys. The total sales for the year ended 31 December 20.18 amounted to 380,000. Wallet Limited has the following inventories on hand that were purchased from Briefcase Limited. Important, Wallet Limited had the following inventories on hand that were purchased from Briefcase Limited. Okay, therefore guys, important to identify. We don't have to do anything with the 31 December 20.17 balance because at this date, Handbag did not have shares in Briefcase. But we need to take into account the closing balance on 31 December 20.18 in our group. Then Wallet declared and paid a dividend of 20,000 on 31 December 20.18. Now guys, I choose to make use of an analysis of owner's equity for my associate as well. However, remember, this is purely a calculation, therefore please don't waste too much time by including different columns. Additional information. It is the accounting policy of Handbag Limited to account for the investment in subsidiaries and associates at cost in its separate financial statements. Remember, this is in terms of our principles of IAS 27. Now, when we talk about our separate financial statements, this is in the annual financial statements of Handbag, the investor, the parent. NCI is measured at proportionate share, and this will be in your group financial statements. Remember, NCI can either be at proportionate or at fair value. If at fair value, you need to remember that your NCI will share in the goodwill. However, at proportionate, our NCI will not share in the goodwill. Number 3, it is the accounting policy of Handbag Ltd to account for property, plant and equipment in terms of the cost model. Handbag Ltd is not considered to be a share trader for income tax purposes and is also not considered to be an investment entity in terms of IFRS 10. Assume a normal income tax rate of 28% and capital gains tax inclusion rate of 80%. Assume a 10% interest rate, nominal and pre-tax. Remember, if we need to calculate our present value, we need to use a pre-tax rate. Therefore, we can use the 10% as is. Let's refer to the requirement section. Once I open the requirement page, I will immediately allocate the minutes to the different sections. Part A, 31.5 marks, therefore 47.25 minutes. Part B, 7.5 marks, therefore 11.25 minutes. And in this question, communication skills, presentation and layout, 1 easy mark. This is not free, but it's easy, 1.5 minutes, therefore a total of 60 minutes. Now guys, if you want to round your minutes up, however, ensure that you stick to the time allocated. Part A, prepare the pro forma journal entries in terms of the investment in Briefcase Limited, point 1 above only for the Handbag Limited group for the reporting period ended 31 December 2018. Journal narrations are required, therefore you need to explain why do you include your journals. Amounts must be rounded off to the nearest rand. Your answer must comply with IFRS. Part B, calculate the carrying amount of the investment in Wallet Limited as it would appear, now this is important, as it would appear in the consolidated statement of financial position of Handbag Limited Group as at 31 December 2018. Your amounts must be rounded off to the nearest rand. Your answer should comply with IFRS.